What's up, guys? I'm starting a new series on YouTube about finance. For those of you that don't know, my name is Julian Romo. And the reason why I'm starting this series is I've received a lot of requests from people that I know asking me for me to teach them about the stock market. I don't really know much about the stock market, but I will teach you what I know. Now let's get to it. This series is going to start telling you about the very basics of investing and why you should or shouldn't do it. We're going to start off here with a little bit of vocabulary, and then we're going to get into more in-depth concepts once we go along in this series of videos. The first concept we're going to talk about is money. What is money? Money is just a medium of exchange for goods and services. Now, I know a lot of you are like, what? Or it might seem obvious. Now, I know you guys work your 40 hours or however many hours you work, and you get a paycheck at the end of the week. You can buy stuff with that paycheck. Now, money started out when people would trade things for the goods that they wanted. An example of this would be, let's say if I was a sheep farmer, I'd have a lot of sheep. And let's say I wanted to buy an ox carriage. Now I'd have to trade a carriage maker or anybody who had a ox carriage sheep, because that's the only thing I had. But what if the carriage maker didn't want any sheep? Then I'd be in a problem. I'd have to go around and find somebody that'd be willing to trade the sheep that I have for what I wanted. So they created money. Now in 1971, President Ronald Reagan, he took the US dollar off of the gold standard. What that basically means is, before 1971, the United States government could only print as many dollar bills as it had gold reserves in the Federal Reserve. And after President Ronald Reagan passed that bill, the government could print unlimited money. Now, they wouldn't print unlimited money because that would devalue it, but they could print more money than they had gold stores. Now, the reason why that's important is because we have something called inflation today. And it's usually around 2% every year. And the reason why that's an important concept is, over time, things start costing more than they did. An example of this would be, let's say in the early 2000s, a pair of shoes cost $50. Now let's say today in 2020, that same exact pair of shoes would probably cost somewhere around $70 to $80. Now that's inflation. The reason why inflation is a bad thing for you and me is, if we save our money over a long time, inflation is going to eat at those cash reserves. Because if we save $10,000 over time, it's not really going to be much. The prices of things are going to go up higher, and by the time we retire, we start noticing, wow, it's not really that much money. That creates a problem, because by the time it's time for you to retire, you're usually at the end of your work life. A way to beat inflation is by investing. You can invest in a lot of things. You can invest in houses, real estate, you can invest in mutual markets, ETFs, stocks, bonds, and CDs. You can also invest in your education. Now, investing in the financial market might not be the best for everyone at this particular time. The reason why I say that is, in my experience, you're going to want to have cash reserves set up in your bank account. You're going to want to have at least 4 to 5 months of cash reserves. Now what that means is, let's say if you lose your job today, you'll be able to pay all your bills for about 4 to 5 months. And then once you have that money saved, I'd say you can put some money aside for investing. The reason why I say that is, so let's say if you get in a tight fix, but you had money invested in the stock market. Now let's say that the stock market crashes and all of a sudden you're in a panic. You're like, stock market's down, I better pull my money out, I need money. And once you pull it out, it's basically a loss to you. Not only did you lose money, but you also didn't have any reserves. So it's like a double whammy. That's why I say having reserves is really important. Now another point that I want to make is, look at the amount of debt that you owe. Depending on the interest rate that the debt is charged and what type of debt that you have, investing in the stock market or investing in anything in general might not be the best idea. The reason why I say that is, let's say if you owe, let's say $10,000 on a car, and the loan rate, the percentage rate that the bank charges you is 10%. Now, in the stock market, the average return of the S&P 500, which is a composition of the 500 biggest companies in America, is about 10%. Now, if you take money out of your savings and put some into the stock market, you don't know whether the stock market is going to go up, down, in circles or sideways within the next year or two. Over time, it's generally thought that the stock market will go up, well, ETFs will go up, or the S&P 500. So, a better option for you to do would be to just start paying off that car loan, because you get that 10% automatically removed from the money that you have to pay. And what I mean by that is, so if the quicker you pay off that loan, the less interest you're charged, because you pay more of the principal off. And the principal means the amount owed. So the last thing I want to show you guys today in this video is about that $10,000 loan that I was talking to you about. I'm going to go in depth with this loan, and I'm going to show you guys something. Alright, let's see. So, here's this board. Guessing you guys can see it all pretty well. So here's that $10,000 loan, right? Here is the interest rate that they charged us. This is how long it took us to pay that loan off, 60 months. And this is the total amount that we paid, $12,748. Now, the interest that you paid in total is $2,748. And that's the amount that you paid in order to receive that loan via interest. Now, here's a different scenario. Same 10,000, same interest rate, 40 months. 20 months less. Let's just say you started hustling and you were like, I want to pay this loan off as quick as possible. Now, this is how much interest you paid in total. $1,800. The difference between $1,800 and $2,748 is $948. That's about a week of work for some of you guys, maybe a little bit more, or maybe a little bit less, depending who you are and how much you make. So that's basically a week or more or less of work that you saved yourself from. Now, this is the funny thing about the stock market and investing. If you put those $948 into any investment that made you 10% year over year, by the end of 30 years, you'd have $16,542. From those 900, that's the crazy part. It's weird how money works. Whenever I started realizing this, I was like, whoa, what the hell? But it's pretty fun. But alright, that's all I have to say for you guys today.